The broadcast is now starting. All attendees are in
Hello
listen-only
everyone,
mode.
good afternoon. Welcome to Alpari's second webinar of the week. Firstly, I have to apologise for everyone who was if you were in the one on Tuesday. We had a few technical issues and the whole thing cut short. Now what we have done is we have rearranged the Tuesday's webinar. It will now be at the end of all these sessions, so check out the webinars page and you can re-register for that one and come back into it at the end of all of it. When we've done all of the webinars, it will be put up there, so I apologise for anyone who was in that. Also, as we go through, please ask any questions that you do have, and we will try and answer them towards the end of the webinar as well. Now, today's webinar is the weekly market roundup. So basically, we just go through some of the major stories which are moving around, which are dominating the markets at the moment. Show a few charts, have a look at some of the indicators, see what's going on out there, and then we take it from there. These weekly market roundup webinars, they are every Thursday. So we've got one today, and then again one next Thursday, and then we'll hopefully keep going. We have a break for Christmas, and then we'll hopefully keep going in the new year. So firstly, introduction to me. My name is James Hughes. I'm Chief Market Analyst at Alpari, and my job's looking at the majority of the markets as we go through the week. So we're going to have a little look at some of the major stories which are going on, and of course the major stories at the moment are pretty obvious. I think it's very difficult to look at anything else at the moment, and with what we've got going on at the moment in the markets, it makes things very difficult for everyone else to really trade. And I mean, trading has become increasingly difficult at the moment with what's going on. But what we do like, and what everyone likes, is volatility. Now I start these webinars pretty much the same way every time with this little adage at the start, which is, you will go to so many webinars, you'll hear from so many different people at different companies, not just Alpari, at various expos and seminars and on TV. You'll hear all sorts of people talk about the markets and talk about what's going on. And there's one thing we all have in common, from you guys as the traders and clients, to us here, from our dealers to everyone. The one thing we all have in common is none of us have absolutely any idea whatsoever where the markets are going to go. That is the be-all and end-all. We do not know where the markets will go, and that is, I think, where a lot of people fall down. I think people fall down by thinking that there is a magic system out there, and at some point you will find it, and we will all become billionaires overnight. And unfortunately, there is no magic system out there. The markets do not move in any sort of pattern, really. They will do what they want to do, and at the moment we are seeing exactly that. Now, there's a few things we can show to gauge a few ideas of where we think the market's going to go, and where we will possibly trade. But of course, the most important thing on the other side of that is to have these risk management tools in place. Have your stops in place, have your limits in place. Make sure that you're protected if the market does go against you. So, looking at the major stories at the moment, of course, yesterday was the big one, which is this concerted effort by central banks to maybe solve some of the problems, or at least get things moving in the Eurozone. For a long time now, we've been sitting around waiting, thinking, what the hell's going on in these markets? We haven't got this major. We've had this bailout plan touted around for a long time, and we've been always talking for a couple of months now that we need to know more details. Implementation is the big thing. That is the big issue that everyone's been looking for. How is this plan, this three-pronged approach to solving the Eurozone debt crisis, how is that going to be implemented? And I think the big stories this week have shown that no one necessarily knows that. But what yesterday has shown, and what this concerted effort, this central bank move from a number of central banks, this is for the first time been the realization that there is this Eurozone problem is a global problem. It is not just isolated to the Eurozone and the countries around there. Every economy in the world will be affected by this if this continues to go the way it is, and that is why yesterday's move is absolutely huge, really, because it tells us that things are starting to change, that the perception of what's been going on is changing, and that these markets are are at risk and these economies are at risk. So there needs to be a settling down. The markets need to settle. And the idea was that yesterday's move to basically lower the borrowing cost for everyone is for financial institutions is going to do that. Now, of course, the skeptics are out there again for this move that it's not going to be enough to solve any problems, and I don't think this has been put in to solve any problems. That's the big thing. This plan has not been implemented to solve problems. It has been implemented to almost give the markets a bit of a shot in the arm and to stabilise the markets, and that's the thing. It's not to solve the eurozone debt crisis, and that's where we need to draw a line from that. And this is where the scepticism comes in, because this process, this move by the central banks is really just a stabilizing effect to keep the markets, give the markets that shot in the arm. And of course they've had that, but today markets aren't necessarily showing too much of the same. I mean, yesterday we saw real big gains. The Dow was up almost 500 points last night. The FTSE was up pretty aggressively as well during the session yesterday. So equity markets have had that shot. We saw the euro, of course, push higher. But what the eurozone doesn't want is this strong euro. The eurozone needs this weaker euro. But what any sort of stimulus, and you can call this a stimulus plan, you can call this a package from central banks, what this does is makes the euro stronger. And we don't need the euro to be any stronger. The eurozone does not need the euro to be any stronger. Okay, so the strength in the euro is not necessarily a good thing. But of course, from our point of view and from a trader's point of view, it's giving us opportunities to trade. So we'll have a little look at what's been going on in the markets. Now, you can see the MetaTrader platform in front of you at the moment. Now, yesterday's move was this. This is yesterday's big move higher. Okay, so, and at the top, at the bottom, I just explain what I have on my charts here. We've got some moving averages. This is a 5-minute chart. So the averages I have on here are 50, 100, and 200. I like to use those on pretty much all of them, actually. Pretty much all of my charts, I tend to have that 50, 100, and 200 day, minute, whatever it may be, moving out. So these are 5 minutes, obviously. So, and underneath we have the RSI, this relative strength index. Now, this is an oscillator. People tend to get a little bit worried when we start mentioning oscillators. And I'm a very technical trader, or I rely on technicals, but not necessarily the big in-depth technical analysis side. So I like to keep things simple and stay with the more basic forms of TA, like moving averages, like just support and resistance, trend lines, things like that. I do like a bit of Fibonacci, but also this RSI, which is the most basic oscillator, and it's just an overbought and oversold indicator. So apologies for those of you who know what this does, but basically we have you have two lines. You have this 70% level and you have this 30% level. Okay, anything that goes above the 70% level is an overbought signal, so it tells us the market is going to come back lower. Anything below tells us the other way, that the market's oversold and is going to come higher again. So I like to use this in conjunction with everything else. So what we saw yesterday was this big move higher on the back of the news probably came out of the US really, or came out of everywhere, that the markets and that the central banks are going to support the markets with this move, to this concerted effort to help out. So with the market, the euro ramped higher, and what we saw straight away was this move from the low to the high here. We got this overbought signal, okay, and this is only a 5-minute chart that we've got here. So we've got this overbought signal, the market much higher, and is really looking to turn around in the short term, and of course it did. We did see this big move higher was always just going to be a reaction. This is always just going to be a reaction to what's going on. Market fell off. Now the big thing that we've got is that it fell to this 50 day moving average, and what we've got here is a nice move. When we look at moving averages and price action, you're looking for in a trend, and then remember this is only 5 minutes, so we're talking much shorter term, but we've got this the price action on top, 50 day, 100 day, 200 day. So that is the order we have when the markets are trending. Okay, and if this was a daily chart, then we would be looking at at this real strong trend. Because this is only short term, we're looking at this to move around. But what we can notice on here is that this 50-day moving average has acted as a bit of support, floating support on the downside. The market came down, we saw a break, but like when you break levels on Fibonacci and like when you break levels on the moving averages, you look for the reaction afterwards. We don't necessarily care too much about the initial break. We look for the reaction after that in the next candle. So we saw the break, next candle we saw go higher. The low was down about on this moving average, and this has been doing exactly the same thing ever since. So we've got this excuse me. We've got this area of support on the downside, which is keeping us give us an area to trade when this market does fall back down. And as you can see at the moment, we are in the middle. We're in the middle of this range. We're in the middle of the RSI. So that's a key signal on the RSI, and the RSI works really good in choppy markets, which, as you can see, is exactly what we've got. But it works great here that when the markets are chopping around, there is no trade when the RSI is sitting in the middle, and I think we can all see that on this chart as well. That the likelihood of a trade here is you'd probably leave it alone for a little while, and you've got this resistance level on the upside, which is the highs from yesterday, the highs of this big move. So that's quite important. Now, what we can also do, and I haven't done this, this is the first time I'm going to put this on, so we'll have a look at it. But I'll add the Fibonacci's to this move here. So the way you add Fibonacci's is insert Fibonacci. Now I'm flying blind here. I haven't looked at this yet, so there may not be anything on it. So let's we're all going to have a look at this for the first time. But let's go retracements. So we're looking at this move here again, short term. The reason I like Fibonacci is because you can do this quite short term. But we'll put it on the lower level to the high over here and see what we've got. And we've got a bit of support on that 50% level. So that's our move. We've got a bit of support here. We've broken 38.2. It hasn't done too much. And again, as I say, when we break these levels, especially on Fibonacci and on moving averages, you look for the reaction. So we saw an initial break here, then the low was much lower again. So we'd have to, although we've then come around, this is too many bars, too much time, too much movement to really say that's a reaction. This could be a reaction here, but we've already broken there. So we're looking at this 50. That was the low, and interestingly enough, it's really jumped higher off of the back of that. So we're going to be looking up here for our next real resistance. Maybe here first of all. So let's get these lines on here. Let's have a look, horizontal line. So maybe here to start off with, maybe this level. Not necessarily here. We'd look to go higher there. So that's where we're going to be looking for these markets at the moment, especially on this on the euro. Interestingly enough, when we saw this break below here, we saw the break of the 50, but only a small break, and the low went down to the 100. So the moving averages are doing their job there as this floating support and resistance. So anything down to 38.2 or towards this moving average is where we're going to be looking for support. So maybe a few trades under there, but of course any trade there would need your stop just below the moving average or just below that 38.2. So that would be a nice place to look for that. And again, there is a chance that because we've had this concerted effort, we've had this move on the markets, and we're seeing a little bit of a shot in the arm for markets, but there of course is this feeling that nothing has been solved and that we're really looking at more uncertainty. The bailout plan is still not going around, and we'll discuss a little bit in a minute about that. The Eurozone looking to boost this ESFS and going around cap in hand to all the countries in the world. But I mean, the issues that we have are still there, so the volatility is likely to stay for a little while longer. Just looking a little bit here at what the euro is doing against the dollar on a daily basis, it's slightly up today again, so we can see that it's moving around a little bit, but we are still slightly higher. So these moves are there. This is what we're looking at the moment for the euro. There are some opportunities there, but I think it's important to look at things going on. There's a question just come through here that agreeing that fundamentals are very important, and I do agree with that. Yeah, fundamentals are important at the moment, but they tend to be misleading, I think, and I think it's hard to gauge anything, because if you look at what we've got here, this short-term chart here at the moment, you can see there's potential trades within that. There are potential areas that we can trade, but there's not necessarily there's nothing there that fundamentals won't completely destroy. So we know that any reaction, any announcement today, not that there necessarily will be, but any big announcement will just smash all these levels completely out of the way, so all of our hard work will be gone. We can see that there will most probably be some trades in this, but I think we'll be looking at the fundamentals will blow this out the water. And usually what I would say is that you you need to couple the fundamentals and the technicals together in order to make your perfect trade. But I think at the moment fundamentals can be very tricky to really give you any sort of idea as to where markets are going. They'll more cloud your judgment, I think. So as people are saying, it is tricky. It's a tough time to gauge. But of course, with this uncertainty in the fundamentals and what's going on, it does give you volatility, and that's exactly what we want. So yeah, just looking at these, and sorry, I was going to show you a couple of other charts, but I couldn't get them over today. We've got a few problems technical-wise again today, which is a bit of a pain. But there's a few things going on in the bond markets as well. We see Italian bond yields fall pretty aggressively on the back of that, which needed to happen. They're back below 7% on the yield, yielding 6.7 now for Italian 10 years, and UK 10 years slightly higher, 2.3, because of the intervention that they're having to do. But again, there's been warnings today that yesterday's move by the central banks, Mario Draghi, who's the new president of the ECB, said again that the move will only be temporary, and that the pockets just aren't that deep, and that's the issue. Again, the Bank of England, Mervyn King, this morning had a press conference where he said pretty much the same thing, and he refused to answer a question on Eurozone breakup. Said what would be the plan he was asked what would happen to the UK if the Eurozone were to break up, and he of course wouldn't answer, which is pretty obvious, but it's a pretty unanswerable question as well. But I think what he was also said on the back of that is that there are plans in place, that they are starting to plan for a breakup in the Eurozone. So again, we can read into that as you will, and see exactly what's going on. Looking at that Euro chart at the moment, we're just breaking that red support level, 34.96 or so. We're just breaking that on the upside here. So move towards this high. The highest from today is going to be interesting to see exactly what we get out of this market. So be interesting to see. So let's move on a little bit. There's another couple of charts. Sorry, let me just find the one I was looking for. I think it might have been dollar Noki. Yeah, this is the one that I wanted to show you, that from last week, or the last time I did last week, George did the weekly market webinar. The week before I did it, and we spoke about this dollar Noki chart and looked at the fibs on this again. And again, what we've seen is this real jump. We did it around this time a couple of weeks ago. We were trading around here. We said this 38.2 was acting really strongly, and again we've got that same thing. We've got this same issue, and look how well this 38.2 held up on this dollar Noki the other week. And we bounced higher. Again, we'd still use this at the moment, I think, because it's a fairly good resistance support level anyway. So if the market came down here, forget Fibonacci, you just stick your resistance level here, support level here, and this is where we'd look to trade. So there are opportunities out here at the moment. This dollar Noki one has been again all over, but currencies are all over the place at the moment, and it's really hard to gauge exactly where we should be, whereabouts in the market we should be, and it's a big issue at the moment as to what should be going on. And again, I'll say something that I say quite a lot of the time, is that, and it's now probably a lot more relevant than before, although the volatility is there, and of course volatility is what we want, just because you have a trading account doesn't mean you have to trade. Sometimes the best trade is not having a trade. So again, it's just the fact that these markets are so erratic at the moment. It's hard to gauge any form of, well, the euro should do this, the dollar should do that, the pound should do this, the yen should do this. It's really hard to gauge at the moment. So I think we should err on the side of caution of these markets. But there's, again, as we say, there's definitely some areas that we can go to. Now, as I said, we're going to talk a little bit about this Eurozone bailout plan and how we're looking to move on that at the moment. And again, as we said, the Eurozone have gone cap in hand around the world to say we need money for this bailout fund, this ESFS fund, which they said in the plan one of the three-pronged attacks would be to get it to get that up to that bailout fund up to €1 trillion. Now it seems that they're getting nowhere near that at the moment. 600 billion euros is the best. They're thinking between 600 and 800 billion euros is where they're going to get to, which of course is just not enough money. It's just not enough, and it's hard when you're saying that almost 800 billion euros is not enough money, but that tells you the scale of the problem. That is the big issue that they've got at the moment. So the fact that we've had to have this central bank intervention. We've had to have a warning from the Eurozone yesterday saying that they need help from the ECB and they need help from the IMF to boost this fund. And the issue is we've heard that so many times now. I mean, if we had a pound for every time we'd heard someone say we need this money we need help from the ECB, we wouldn't need to trade, number one. So it's really interesting to see at the moment where this is going to go, and I think more than interesting is a little bit worrying, because they just don't have the money in this bailout fund at the moment, and that's going to be a massive problem. And of course, what we've also got, we had the Greece issue, which was still not gone away. It's just gone out of the news. We had the Italy issue, which again hasn't gone away. It's just slowly going out of the news, and there's another country moving into it, and that's Spain now. So it's exactly this same thing. These pigs, as we've said before, are the ones which are doing it. So Portugal, Italy, Ireland, Spain. This is where the issue is coming from, and Greece, of course. This is where we're back to square one again, and it's almost like we're a broken record. A lot of the headlines this morning on the papers are saying that the credit crunch is back. This is again just as bad as it was 3 years ago, and almost we're looking at maybe something a little bit worse. Not meaning to be completely and utterly down and out and really downbeat on things, but it's hard to look anywhere else. But of course, what this gives us is the volatility in these markets, and that's a real good thing that we're looking for. Let's go to this euro dollar at the moment. Right, interesting move on the upside here that we've come up to around this sort of level. So we've gone back down again. Again, short term, we can't really look fundamental wise here at the moment. You're just looking technicals and how people are reacting. Bounces off of these levels and moving lower again. So interesting at the moment. We could be looking at some kind of trade from this point of view at the moment, but of course a little bit of caution, because still the RSI sitting in the middle here, not showing overbought or oversold, just showing markets chopping around a few pips here and there. So hard to gauge. So let's have a little talk about the UK. Of course, it's been pre-budget report week. The autumn statement was out this week, and it didn't make for too much positive reading, of course, for the majority of us. The headlines from that were, of course, that the growth figures that the Chancellor pulled out in the spring were nowhere near what they thought they were going to be. The fact that by 2015 the government are going to have to borrow £112 billion more than what they thought. Now, that's a pretty big oversight on their behalf. And whether you like the coalition or whatever your political stance is in the UK at the moment, I tend to think that they haven't necessarily done too much of a bad job. However, there is this growing feeling that every time the Chancellor speaks, he is getting he's using this same line that the coalition has been using since the start, and that is the fact that what we inherited was that bad and deeper and worse than what we thought to start off with. And of course, that's not what we don't want to hear that anymore. We know it was bad. Everyone knows it's bad. Look at the world. Look at what's going on in all these economies. We know that things were bad. You can't blame Labour for everything. So it's the fact that they keep blaming everyone for it is becoming a bit of an issue for everyone. Everyone's a bit bored of hearing that. But one thing he's done, he's kept these borrowing rates low, so these 10-year yields are still very low. So borrowing is at a cheap rate still. That's good news. Cheaper because now we've got this interbank and central bank move to make things cheaper. So overall, from a city point of view, so looking at those financial companies in the city, they're not too displeased with the Chancellor, and the fact that it's tough around the world. But the headline figures were pretty bad. The fact that inflation is going to be move steadily higher than the increase in income until around 2015 again, which is not good news at all. And that's probably the worst headline that we had out of it. But when the other opposition is, and again I'm gonna nail my political side to the mast here, but just say that the only thing that Ed Balls could come up with during that, I don't know if anyone saw it or watched the statement or the bits in the House of Commons, and I don't like to jump on this bashing of Ed Balls like everyone else does, but Ed Balls did have a little bit of a tough time himself. Okay, it was a bad day for the Chancellor, but the only thing Ed Balls could come up with was the fact that what they had said before hadn't worked, and of course we knew that wasn't going to happen, and he didn't come up with any ideas for himself, and the fact that he's the most irritating man in British politics doesn't necessarily help him either. So there's some issues going on within the UK, but it is tough to gauge. But looking at this cable chart that we've got open at the moment, markets, again, you've got these moving averages on there, and I think we've only got 100 and a 200 on this at the moment, but you can see the big moves have come. Again, from this point of view, we've got price action, moving average, moving average. So we've got quite a nice amount of price action here. We've got these moves to the upside. Now, every time the RSI has jumped above the 70% level here, it's worked out well for us. So a jump above the RSI back on the 29th of November, move lower, only a 30-minute chart again here, so we're looking more shorter term. A couple of weeks ago, we were looking more longer term. This is a lot more shorter term. So jumped above this 70% level, move lower. Again, this low level, drop below the 30%, oversold signal, market went higher. Again, we've had the same thing here. Markets come lower. Now, we didn't quite get as down as far, but we held up on the moving average. Didn't quite get to the bottom of the RSI. But now, again, we're in the middle. We've gone to the upside. We're coming back down lower. So there's potential trades here. You've got this moving average on. You've got the high there. So there are potential shorter-term trades that we can all look at and we can all try and look to. But again, the pound, it is this story of these three ugly sisters at the moment still. You've got the pound, the euro, and the dollar, and it's whoever's ugliest at the moment is winning. But everyone's had a bit of a shot in the arm. So these ugly sisters have had a facelift over the last couple of days, and there's nothing else that is really getting into the market at the moment, because this is the only story, and the market's so fickle. It will only take those things that it wants to hear. So you've got that. Whether it be good or bad news, that doesn't mean it only takes good news, but you've got this shot in the arm. Whether it's going to work or not, the market doesn't necessarily care. All it knows is that it's a shot in the arm. It's a nice move to the upside, and we're going to start performing slightly better. So again, there are some potential. There's potential for trades here, and especially on cable. I'd say keep an eye on that RSI at the moment, because it's really been acting quite nicely, and it's given us quite a few indications. So the RSI is a nice one to look out for. I'll show you how to put it on to your MT4 charts. Again, insert, indicators, oscillators, and then RSI, relative strength index. That's the one we're looking for. Sorry, not relative vigor index, relative strength index. That's the one we're looking to put on. So again, it's a nice indicator. It's really simple to understand, and if you can keep those on and keep moving with those, and take them with a pinch of salt as well. This is the other problem I have a lot with technical analysis, and sometimes you have real purists, and apologies if anyone out there is a purist in this form of TA, but you have to give these things a little bit of leeway. I can't agree with a lot of these people that say, well, you've only got the markets reacting the way they react, and every pip has to count. Now, if you see a break, you have to give it some leeway. You have to see what the reaction is. Nothing works to an absolute science, and that's the problem that a lot of the purists in TA fall into, because they use these and miss out on opportunities when you follow things to an exact pip. In Forex at the moment, on a daily basis, on an hourly basis, on a minute-by-minute basis, on a tick chart, a pip is not a lot. It is not a big move. So you have to see and give these markets a little bit of leeway in order to not miss out on opportunities and give your trade a bit of time. I know we always want to get rid of that emotional side of trading, and never ever moving stops is definitely the one thing not to do, but you need to give it a little bit of leeway. If you stops there, that's fine. But if you're just looking at the market, looking to get out of a trade, or just looking to see if a technical idea is still going to go, give it more than a pip, give it a couple of pips, just give it a little bit of common sense. That's always the only thing you can say is a pip is not a lot, and you need to give these things a little bit of leeway. So all in all, this week has been a real busy one. There's been moves, there's been volatility, there's been central bank intervention, there's been more stories about the Eurozone, the autumn statement out of the UK. It's really, really busy one. So next week, who knows what's going to happen. People say that we start slowing down for Christmas, but into next week, 1st of December today, so the people say it's going to start to slow down. Whether it's going to or not is the big question, because there's so much volatility. One thing that will happen is if we do slow down for Christmas and volume does drop off, volatility gets more increased. So chances of seeing some bigger movements and seeing TA and this technical stuff work a little bit better is going to be out there if volume does start to fall. And inevitably, volume does fall around the Christmas period. So look out for those bits of volatility. If anyone has any questions at all, please ask away. If not, you can send emails to if you have any questions. That's to webinars@alpari.co.uk if you have any questions, and I'll pick up all those emails. So feel free to send over any charts you want any advice on or anything like that. If you have any queries at all, then please do let me know, and I'll do my best to try and help you out. But apart from that, it doesn't seem like there's any questions on the list there that we haven't covered already. So apart from that, thank you everyone very much for listening. We'll see you next week for our next round of webinars. So have a good trading for the rest of the week and have a good weekend, and we'll hopefully see you next week. And remember, those of you who were there Tuesday and who saw the webinar that cut out, and we apologise again for that, but that has been rescheduled to the end of the series, so please go back in there and sign up again. But apart from that, thank you very much for listening, and we will see you next time. Thank you very much.